that case, our balance sheet is going to be disturbed. It's not going to be stable. But can we directly write off? Yes, we can do that. In that case, what happened? We record expense when specific customer proved to be default or uncollectible. Remember, this write-off method is not recommended by the law. Law is generally accepted accounting principles, right? So they say that no allowance for uncollectible debt, which is you need to, it says that direct write-off says that there is no allowance method. You don't maintain an allowance method. Why? Because for that one, it is, a little bit difficult. You need to hire a person who know all this stuff, right? And it also state that the receivables may be overstated. When we write down the account receivable, we write it down the receivable value minus the allowance. Then we write down this value. But if we don't write the allowance, the account receivable will be higher number, which is overstated, right? So this account receivable is vulnerable to market conditions, whether people pay or not. If they don't pay that, then account receivable will decrease. When account receivable decrease, your balance sheet value decrease as well, right? Plus, it fails to recognize expense in the same period in which sales revenue is earned. What if your sales happen in September 2021 and your collection was supposed to be 2022? So you recorded your sales and show your profits in 2021, but when collection is not happen in 2020, then you record your expense in 2022, which is not according to the principles, matching principle, right? This expense that they are not being paid, this expense belongs to 2021, but this is now 6 months have gone. This is March, but you cannot change the previous already published accounting statement, income statement, because every company, public company, listed company need to present their income statements at the end of the year, December 31st. And it will go directly the Security and Exchange Commission. But your collectability is to be scheduled on March 2022. It needs to not happen. So expand happen, can you reverse backward? Answer is no. So that's why it is not recommended by the law. Plus, required method for federal income tax purposes. But if you are using income tax services purpose, then you can directly write off this method. Don't worry about that. Why? Because in taxation matters, the government say that you can minus the actual number of the uncollectibles. You do not minus the allowance. Okay, you do not minus the allowance. Why is that? Because if you minus the allowance, entry would be the, let me write it down. Entry would be the expense to allowance, and this expense will go to income statement, sale minus expense, and it will decrease the income. When it multiply by the tax rate, tax will be low income multiplied by the tax rate, magnitude of the tax going to be in dollar term, tax going to be decreased. So government say that do not do that. Use direct method so that we are not dealing with the allowance, right? The actual number, you delete that one, you mitigate that one, you write off that one, and then we will see the tax revenue. That's it. Now you understand? So if you understand, let's do this example here. So the journal entry to write off the $9 million expense, uncollectible expense from RS, simple. The expense to account receivable. Account receivable decrease, we decrease the account receivable by 9 million, and this 9 million is charged to the expense to account receivable. If we are using some the allowance method, then here we will be charging this to allowance for uncollectible to account receivable. But since we are direct writing off, so we are not using or not making the allowance, so we directly charge the account receivable to our expense. Entry would be uncollectible expense to account receivable. That's it. That is direct write-off method. But remember, law doesn't support that one because it has a judgment and judgment issues, and because of that your balance sheet is going to be up and down. So law doesn't support this one, but taxation department supports that one, because in that case you are be paying higher taxes based on actual, or taxes based on actual data rather than allowance. Now, computing the cash collection from customers. When we are using the cash collection from customers, we already discussed that one, because the left hand side is the debit side, which shows how much the balance that this total accounts receivable need to pay us, and the left hand side, credit side, tells us how much they actually paid, right? And the balance is still outstanding, right? So if you see here, sale happened, it is 1800, so accounts receivable to sales, right? Sales here. And uncollectible, if happened, so allowance for uncollectible to account receivable 100, so it charge here. And if customer paid us 1500 here, so balance would be 400. So this is how we calculate collection from the customers. So remember, if there is an allowance, so remember that one, on credit side, we need to account for this 100 as well. If we don't account for here answer would be 500, right? So if we have allowance here, so it means 100 here. So that's why we have collection that is still pending from our customer, 400, but it has nothing to do on cash collection. Only if we ignore the write-off stuff, the value going to be inflated, 500, but it has nothing to do with cash collection for customers. But remember that one, if there is a write-off, you need to be very careful. A write-off, and then on the right-hand side, there is a cash collection. So you can generalize that one. On the left-hand side or on the debit side, there is a normal balance, and on account sales, on the right-hand side or on the credit side, there is a write-off and cash collection. That's it. And you balance them, you can find out the balance. So you can also find out the cash collection. Now we already know that, but you can also rearrange this left-hand side is equal to right-hand side to find out the balance. So we know that the left-hand side or the debit side is 400 greater than the credit side. So answer here would be how much? If this is total value is 2000, right? 2000 minus 400 minus this 100, 1500. So you can balance this and easily find out the missing value here, right? If there is no write-off, then it would be 1600. If there is a write-off, it would be decreased by the write-off, 1500. Now the accounting for notes receivable. It's very simple. Just one added flavor here is the interest income. That's it. So this is the terms. Creditors, those who provide the loan, normally these are the company. Debtor, party who owes the money, or maker or borrower. Remember, The note receivable is made by customer, so customer is our debtor. Interest expense, cost of borrowing, and it is stated in annual percentage. Let me highlight this one. It is annualized percentage. How much money is used, you multiply that according to the months or days, and you can find out the interest number, dollar value. Maturity date gonna be there, maturity value gonna be there, maturity value gonna be the sum of principal plus interest. And principal amount gonna be mentioned here, and the terms are also there. For example, those who possess, that person or that company who possess this notes receivable will be given the amount. If a company, if for example, if I am the company, I receive notes receivable, I can also trade this note receivable to some other person. I can say I can say to the other person, okay, look, I am receiving this money in 6 months, so rather I wait and I need to give them money. I hand over you this note receivable, and after 6 months, the party, my customer, will pay you directly because you are the holder of this note receivable, right? So length of the time when notes was signed to when payment must be made, all the terms and conditions going to be mentioned here. Who made payments to whom and all those stuff. Remember, it can be current, it can be long term. If the maturity date is less than 1 year, then it will be current asset. If its maturity date is greater than 1 year, then it would be long term. So you need to see the maturity date, maturity period. So normally promissory note looks like this. It is printed or it is mentioned on companies, company letterhead. It will be mentioned here, company letterhead. You write on promissory note. This is the amount. That is the date when it is written, maturity date. This is the value of dollars here and annualized amount here. Annualized interest amount, right? 1,000. So at the end, how much you need to pay? 1,000 plus 9% till how much it is outstanding. 31st December, August 31st to February, February 28, which is I think 6 months, right? Yes, 6 months. So let's see that. If we are having our question here, we will be seeing that. See, that is the interest period start, and that is the payee, the maturity date, interest rate, which is annualized, debtor payments already there. Who is the debtor? Who signed it here? So you sign. This is the signature here. Now consider the Lauren who issued the 1,000 this promissory note. We just see that here, 6 months note. So after Holland signs the note, the Continental Bank gives her 1,000 cash, right? The bank makes the following entry.